Ladies and gentlemen, welcome to the Business Brew. I'm your host, Bill Brewster. I'm joined today by Kyle Cerminara. As a reminder, nothing in this podcast is investment advice. This is not an invitation or solicitation to buy or sell any securities. The information in this podcast is opinion-based. You should assume it's biased. I got connected with Kyle from my man Mike Mitchell. Mike Mitchell was featured in episode 1, and Mike is pretty public about owning shares in some of Kyle's companies. I own some shares in some of the entities mentioned, and I will commit to not selling them for at least a year after this airs. But that is the bias that I carry into this, and I obviously want my man Mike to do well, and I've gotten to know Kyle pretty well and thought that he would be a really interesting guest to feature on this podcast. So with that, Kyle, what are all your official titles?
Really, I'm the founder of Fundamental Global. I founded Fundamental Global in 2012 with my partner, Joe Moglia, who was the chairman and CEO of TD Ameritrade. And ultimately, everything I do is as a function of being the founder and CEO of Fundamental Global. So all the portfolio companies that I'm involved in, are as a result of being Joe's partner at Fundamental Global. And, I'm the chairman of a number of public companies. I'm the president of a SPAC called FG New America, but they're really related to my role at Fundamental Global.
I'm sure you're not tired at all, huh? It's not like you're working around the clock.
This has been we've got a lot going on right now, as you've probably seen. So it's been a busy few weeks, but we had to fit it in. So I'm glad to do this.
Thank you for carving out some time. For those that don't know, you've got in your public portfolio, you've got Ballantine, right? BTN. FGF is FG Financial, right? You've got Itasca, which is now Green First. So that's 3. And then you've got FGNA, correct?
Yeah, the way I think about it is, we used to have a much larger portfolio. I'm a big believer in focus, and, there's only so many things you can do. So we really have 4 portfolio companies that we're highly focused on, plus the SPACs. And, that's Ballantine Strong, ticker BTN, BK Technologies, ticker BKTI, what is now called Green First, which trades in Toronto under GFP.V, and of course FG Financial, ticker FGF. And under FGF, we have SPACs, which we are sponsoring, the first one being FG New America, which is ticker FGNA, which we announced an IPO in October of last year, and then we have already announced a definitive agreement to acquire a company called Opportunity Financial, or OppFi, which once we close that deal in June, will trade under OPFI.
So after saying you're a big believer in focus and then rattling off all those entities, I have to ask, how is it possible to do as much as you're doing right now?
We have great teams. Each one of those companies has their own CEO and a team underneath them. Ballantine's historically had over 300 employees and a CEO and CFO, and BK Technologies has its own team and board of directors, and it is a lot of work. Sometimes my wife asks me, why are you doing this? And I look back on it, and my kids ask me, why are you doing this? And my kids are now 12 and 10, and I look back and say, it would be great to spend more time with them, but it's true. It is a lot, but I'm pretty passionate about each of these companies. And we started out to make money in them. These aren't the only ones that we had. We had more of them, and we made some significant investments. We had a company back in 2015 that we started in 2012, 2013 called Magnatech, which traded on the NASDAQ under MAG. I joined the board. We bought the stock when it was $10, $11, $12 per share. I joined the board, and ultimately we hired Goldman Sachs and sold the company to a company called Columbus McKinnon for $50 of cash. Same with a company called Iteris. I joined the board in 2017, and the stock went from $1.80 to $7, and I resigned from the board a year later, and we sold the company for an enormous gain. So with each of these, we get involved and we try and improve them and make money, and then, ideally move on. Sometimes it takes a year, sometimes it takes 3, 4, 5 or more years, but the goal is not to stick around for an eternity. It's to make money and improve the situation and then ideally have shareholders be in a better place. It doesn't always happen that way. I think you learn a lot along the way. So we certainly had a very favorable outcome with Magnatech and Iteris and GreenFirst, and with some of the others, it's taken a little bit longer to have a favorable outcome, but we'll get there.
Can you go through a little bit of the background on GreenFirst? Because that's kind of interesting to research, where you sort of ended up with, I don't want to say sort of, right, because that implies it's happenstance, but you found yourself with a pile of cash at the right time and worked hard to get a deal in front of you and created a fair amount of value if the market's remotely correct on the bid today. Out of thin air there, right? It was the right setup at the right time.
Yeah, so GreenFirst is a long story, and I'm happy to share it briefly. The company was originally called Cobex Capital. My partner, Larry Sweats, founded it when he was the CEO of Kingsway, and he actually went activist on it. It was a pile of cash. They were making investments inside of it, and the former board, and he went activist on it. We eventually convinced them to liquidate it, and Kingsway owned at the time 15% of it, and I thought it was an interesting company, so we at Ballantine Strong took a 15% stake as well. So between Ballantine Strong and Kingsway, we each owned 15%, and the company tendered to buy 85% of the company. And Kingsway agreed not to tender their shares. So with Kingsway agreeing not to tender, you essentially had a company that was going to, at the very minimum, have a few $1 million of cash. And with Ballantine Strong buying shares, our board looked at it and said, well, we can either tender or not tender. We'll make the decision when the tender comes. So the company had significant, about $30-40 million of NOLs, net operating loss carryforwards, inside of it in Canada. We thought those might be valuable. We had some Canadian operations. It obviously had some cash, and we had a strategic view on it. We thought we'd see how things settled out as the tender came through. Larry and I called, a bunch of the shareholders and said, consider sticking around. This is what we'd like to do with the company. And we had a list of the shareholders. We called probably 100 shareholders over a period of time. And a bunch of them decided to stick around, and we were thankful for that. So some of them tendered, some of them stuck around. And that resulted in Ballantine owning a third of the company, Kingsway owning a third of the company, and then some very thoughtful shareholders that stuck around owning a third. And that was at, I'm going off the top of my head, call it like 50 cents a share. 56 cents a share at the top of my head. At 56 cents a share, we had cash. We had probably $1.50, $2 a share of NOLs. And we started looking for something to do with that cash. In Canada, the laws are pretty open-ended about what you can do. So we started looking for some opportunities. Kingsway was in the middle of sponsoring a SPAC. I had no idea what a SPAC was. Larry called me. I had 102-degree fever and said, are you interested in participating in the back end of a SPAC? And I didn't know what the back end or a SPAC was. And
yeah, what end am I on, and what is this?
Yeah, so I was like, what is a back end? What is a SPAC? And I've got 102-degree fever. Leave me alone. So he walked me through it over 2 or 3 days. We worked about 20 hours a day with me, having this awful fever. And I was like, this is the most fascinating thing I've ever seen. And I was like, this is an insane deal, but I need to protect shareholders. Of Itasca Capital. So we put together, I sort of represented shareholders of Itasca Capital. He was focused on the SPAC. And
so can I just real quick, so Itasca was your slice of the deal that you encouraged shareholders to stay around for?
Yeah, so we changed the name of Cobex Capital to Itasca Capital. I'm sorry, I left that out. Cobex was the name of the public company that eventually changed into Itasca Capital. Itasca was just the name of the town that Larry lived in Illinois, outside of Chicago. But it also has two meanings. It's the name of the town that he lived in, but it's also a symbolic meaning, which is sort of like a well of, if you Google like Itasca, it has a interesting sort of like endless flow of water into the Mississippi River. The word Itasca is meant to be this lake, Itasca Lake, I believe. that flows in. It's supposed to be the source of the Mississippi River water. So basically this never-ending flow of water that flows into the Mississippi River that ultimately flows down into the Gulf of Mexico. So if you think about it like symbolically, it's like a never-ending pool of capital that flows into the Mississippi River, right? So, that was sort of the concept of Itasca Capital, the word Itasca. I didn't come up with it. I won't take credit for it. That was Larry's idea. It was already named Itasca Capital. That was Larry's idea. And the word Itasca has always been sort of his idea. But anyway, we decided to do the transaction inside of Itasca. We had a favorable outcome. It was ultimately Limbach. The way the deal was structured was that, to simplify it, Itasca Capital shareholders received a 12% payment in kind or PIK preferred, plus about 43% of the upside of the SPAC sponsor. So it was a pretty favorable structure. And with that, we ended up making about 50% on that investment in about a 2 or 3 year period. And we dividend that out to shareholders right after the investment was liquidated in, about 2 or 3 years later. And then we were left with $10 or $11 million of cash. And we used some of the NOLs on that. And fast forward to February, March of 2020, once that was liquidated, we said, well, what do we do with this cash now? And we were under some pressure from shareholders to liquidate the company. So we were
Is this how Mike found you? When did Mike find you? When you were distributing the initial distribution back to shareholders, or once you were under pressure to liquidate?
No, so the pressure from shareholders started to come when people were saying, you should liquidate this company. All right, it was trading at like 45 cents. And everyone's saying, we want our money back. And we're like, okay, well, we're happy to give it back because we own a lot of it. Larry at the time, so during that time, Larry left Kingsway, which is a long story in itself. And Kingsway still owned a large stake. And I wanted to help clean that up with Kingsway. So I saw the opportunity to buy shares. Fundamental Global bought Kingsway shares for 30 cents per share. There's a press release that if you Google Fundamental Global and Itasca Capital, you'll see that we bought the shares in Canada.
So why did Kingsway sell at such a discount, right? Because it was 40 and what did you say? It was like 46 cents and now you're buying it at 30. Is it just that they wanted the liquidity?
I don't remember the exact price of on that day, but maybe it was trading for 40 and we were trading, we were sort of cleaning up the affairs and it was a very illiquid stock and
so they wanted the block out, right? So if you sell the block and it's a liquid, you're going to take a discount. Okay.
And it was a small investment for them, a few $1 million. I think it was like $1 million that we paid for it, right, at that price. So it's in the press release. I don't remember the exact amounts. And then Larry also, he had Kingsway RSUs and shares, and he swapped his shares for Kingsway at that price, or for Itasca Capital at that price. So we were thinking about just liquidating the company because everybody was saying, hey, you got to liquidate. That's what people do, is they pressure you to do things you shouldn't do. So we thought about it. We did a thorough analysis of liquidation because that's what we do, is we do thoughtful things. We evaluate every single thing we should potentially do. And, we hired attorneys to look at what does a liquidation look like? And it was expensive. In Canada, it takes 2 years to liquidate a public company, a minimum. You're required to keep a public company public for 2 years before you're allowed to shut it down. So shareholders weren't going to get all their capital back for 2 years. It was going to cost us millions of dollars to pay attorneys to do this. We only had 10 million, so we're going to pay millions of it out to attorneys. And by the time shareholders got their money back, it would be a lot less. We were the biggest shareholders, so we're like, okay, so we're going to go pay attorneys so that people that want us to, quote, liquidate the company can be happy that we did. And we're like, we're the largest shareholders. We think that this is a bad idea. So before we liquidated it, we said, let's just at least see if there's any interesting opportunities. And then this is literally the week before COVID hits. We're thinking about liquidating it. And everyone's like, oh, you should liquidate it. And we said, oh, look, we totally agree. We should evaluate that. Let's consider it. So we considered it. And then COVID hits. And it was like, oh, thank goodness we have $10 million in cash. So we called up our friends at Fairfax Financial, and Paul Rivette had just left in February. Larry had developed a wonderful relationship with Paul over the years. And He had retired from Fairfax after 19 years as their president, and was looking, he had just bought the Toronto newspaper, which is sort of like the prominent newspaper in Canada, and was looking for some other things to do. And he had a interesting thesis on lumber and had this sawmill was ready to buy it under LOI, letter of intent. So we said, well, would you do it inside of our cash shell in Canada? And he's like, absolutely. Let me take a look at it. So we ended up doing it inside of that. He and his partner, Rick Domain, ended up investing $5 million into the company. And with the thesis, if you read sort of the documents that was put out publicly, that this would be a platform for future acquisitions. Like, that won't be the last one. That was a acquisition that we made that this will be a platform for timber acquisitions, and very focused timber acquisitions. That's why we changed the name to Green First Forest Products. That acquisition was made, by my calculations, at less than 10 cents on the dollar. If you look at the price of lumber, it basically tanked in April of 2020 because people thought the world was ending. And now we're in the middle of like one of the greatest building booms in history. And the price of lumber, you can't find lumber anywhere except for on our acreage where we have lots of it. And the price has gone through the roof, and that asset is worth like tremendously more than we paid for it. And we have some other really interesting opportunities now that we will likely pursue inside of that vehicle.
Yeah. Sorry. I'm just thinking through, like, how do you think through when you're dealing in a commodity type business? I mean, right now we're sort of looking at a lumber spike. How do you think through what normalized lumber price is versus how much of this is sort of a temporary shock because of COVID? It seems like a very, very funky time to plan what might happen to commodity prices. So how do you think about that?
There's a futures curve. It's not that long, but there's a futures curve. And in addition to that, you have to go out and say, what does our earnings look like if the price of lumber declines by a certain percentage and, normalizes? And we've done that. So we don't assume that prices stay high forever. In fact, we always forecast declining lumber prices because that's prudent. In every transaction we would look at as an acquisition, we would assume prices decline, but the numbers make sense with prices down 40, 50% from here. Right? The numbers make sense with numbers down a lot more than that. So you don't have to, this is just all bonus right now. You don't have to have the numbers at this level to sustain. Like, we didn't expect prices to go to this high. If they stay this high for some period of time, that's great. They don't have to. This is just nice. But even if they decline by half, it's still amazing. The asset is amazing with the prices down 50% from here.
So why was it shut down when you got it?
Those are long stories I'd rather not go too much into sort of the history and the details of like why we took an asset. That people sell assets for all kinds of reasons. And we were very fortunate to get it at a period of time when others were less fortunate. I'm happy that we were able to buy the asset and sort of take it on at a time when others were looking to monetize it. So
yeah, that's the optionality of cash, right?
Yep.
So I think, if I'm listening to this, I would think, how the heck did this guy get where he got? So do you want to go through a little bit of your background?
Sure. Yeah. So, I really don't like to talk about myself, but I'll give you like sort of the quick 2 minutes, and you can ask me questions and I'll try not to answer them.
That sounds good. Yeah.
But I was an aspiring tennis player growing up. Thought I'd play professional tennis, met my wife in college. We're still together. She's the best wife in the world because she puts up with me working till 2 a.m. every night and weekends. And I met her and she's like, look, like, we went to college in the 1990s when it was very similar to today, where basically you could buy any stock and it went up. So I thought I was like the best stock picker in the world, as many people do right now, because like literally you could just buy anything and it just went up 100% the next day. So I got really interested in stock picking in like 95, 96, 97, 98, 99, like when I was in college. And Ameritrade and E-Trade and Scottrade and all the online brokers were just starting accounts. And I I decided to go into your traditional investment banking program. So I did that. And, if anyone's in an investment banking program right now, I feel so terrible for you because it's like the most miserable job in the world, but you learn 50 years worth of stuff in like 10 months. And then you gain like 30 pounds and you feel like you're going to die every day. And it's awful. It's like I don't know why, to the point that was made, I think, in the Wall Street Journal this week. Like, I don't know why people have to work 100 hours a week or 110 hours or 80 hours or whatever it is. People do work an unusual amount of time as an investment banking analyst, and it shouldn't be minimized, like how awful that job is. But it's exciting too, as like a 21 or 22-year-old, like you're put into all these like bizarre circumstances where you're presenting to boards of directors on like why they should merge with this company or that company. And you're like, well, I was like at a fraternity house like last month, and now I'm presenting to a board on why they should merge. Like, how is this possible? So it's it's a very interesting dilemma. But then at the same time, you're in the copy room, like printing stuff at like 2 a.m. It's like, it's such a strange, I don't know why it is, but that's just the history of Wall Street. And that's how investment banking works.
The thing I never understood, man, was I would watch those guys and they'd sit around from like, I don't know, they'd probably get to the office at 10, right? Because they were working until 3:30, 4 a.m. or whatever. So they walk in at like 10 and they're not doing much for most of the day. And then, I don't know, 4 or 5 o'clock rolls around and I guess it's time to get staffed on something. So it's a lot of sitting around to hurry up later. That would be frustrating if you were living a life.
Well, I was an investment banking analyst pre-TSA. So we would print the pitch books and then drive them to the airport, park our car like at the curb, and sprint through like security without like TSA
to go give it to people that were getting
to go
on the
give it to
airplane?
Someone who was like sitting there waiting to board a plane with your car sitting at the curb like with blinkers on. And it was just like, what am I doing with my life? Like, how did this happen? Right. So I remember like Father's Day 2000 or 2001. It was like Sunday, and I'm like out to lunch with my dad. My managing director calls me. He's like, I need you to come in. And my dad's like, you can go and do this, but this is the last time. And I guess like 21 years later, I'm still doing it. But
yeah, it's different though. You're doing it for you this time.
So I go, and a couple months later, I interview with T. Rowe Price, which was literally right across the street from Legg Mason. There was an amazing opportunity to work for a woman named Anna Dopkin, who was the director of research. She ran the financial services team back then at T. Rowe Price, and she was former Goldman, had come to move from New York to Baltimore to run the financial services team at T. Rowe Price, and she knew what I was going through, having been at Goldman, and she's like, "Come work with me, and I promise you'll leave at 10 every night." And so I went to work for her. She was an amazing mentor, and she was promoted to director of research like a few months after I joined, and I was like 22 or 23 years old. And typically at T. Rowe, every analyst there is Wharton, Harvard, or Stanford, MBA, and I was a 22, 23-year-old undergrad. And Anna's like, Kyle can do this job, give it to him. And she sort of made the pitch that like I should take over much of her responsibilities. As like,
what do you think she saw in you to give you that kind of responsibility that young?
I don't know, but I'm glad she did. I remember sort of late 1990s, sort of watching CNBC and trading stocks and watching like the T. Rowe Price portfolio managers on TV, thinking like, wow. And then her giving me these responsibilities, and then going into the T. Rowe Price had what was called the Monday morning meeting from 8:30 in the morning to like 12:30, and now I'm going into the Monday morning meetings, like pitching like these large cap stocks to the same people I saw, I was watching on CNBC. And I'm like, what am I doing? I'm like 23 and I'm pitching these huge cap stocks to them. And this is crazy. So it's like an amazing place to grow up and learn research. Like T. Rowe Price has an amazing research culture. They do amazing research. You learn, you have all the resources in the world. You have anything you need. You spend tremendous amounts of time, great resources. And I learned from some of the best people, like at a very young age, like how to do some of the best research. So, and it's like great, deep, fundamental research. Like T. Rowe Price sort of like prides themselves on great fundamental research, deep, long-term, 3 to 5 year thesis. And
so what does that look like for somebody that doesn't know? You're talking to a lot of industry experts, getting on a plane, going to talk to management teams, etc.
yeah, so everything's sort of sector by subsector, right? So my first subsector, and this is an interesting story, was the business development company. So when I was an investment banker at Legg Mason, I had banked telecommunications companies. So I come over to T. Rowe Price and they give me the business development companies. At the time, there were only 4 publicly traded business development companies: Allied Capital, American Capital Strategies, MCG Capital, and Gladstone Capital. And Allied Capital has now become famous because there's a book about it, which I'm a character in, called Fooling Some of the People All the Time, written by David Einhorn. And the book is really interesting, but before we get to the book, I'm given the sector and I spend 10 months researching these 4 companies, interviewing the management teams, going through their Qs and Ks, going back 10 years, writing like a 50-page research report on them, putting together a 40-page presentation. And ultimately, it sort of culminates in the Monday morning meeting where I have to give like this big pitch to everybody on like what we should do with each of these 4 stocks. Should we buy them? Should we hold them? Should we sell them? And I was like, we should sell Allied Capital. And that was extremely controversial because Allied was, a stock that we had owned for a long time. We had a great rapport with management, but I knew the portfolio companies, and I was like, many of these portfolio companies are not companies that I think are valued appropriately. So, I
and
had
because of that, you thought the BDC itself was overvalued?
I thought the BDC was overvalued because I had banked a bunch of these telecommunications companies, and I knew that they were toast. So I was young. People didn't necessarily agree with me. And we sold a little bit of the position, but we didn't sell the entire position. So I got a sort of like, okay, good job. We'll sell half the position. We'll sell half the position, but we won't sell the whole thing. But we did sell some of the position. And David Einhorn, who wasn't a well-known commodity back in, not many people knew who he was back in 2001. They were starting to know who he was, but he was running a $1 billion fund. He wasn't who he was during the financial crisis or now. Fast forward to the Ira Sohn conference, which is a pretty famous investment conference in New York, where hedge fund managers get together and present their best ideas. If you Google Ira Sohn conference, Allied Capital, Greenlight Capital, David Einhorn, you'll see that there's a very young David Einhorn wearing a goofy tie, sort of presenting Allied Capital as a short, and he sort of laid out the thesis that I put in this presentation a year earlier to T. Rowe Price. And the stock, he becomes instantly famous on this pitch. The stock falls 40% the next day. The portfolio managers run to my office at T. Rowe Price and say, what do we do? What do we do? I'm like, I told you about this.
To sell a while ago.
I told you to sell. Like, why are you panicking today? Like, I told you about this like 6 months ago. So I was like, what? They're like, well, what do we do? I'm like, you buy. And they're like, what do you mean? I'm like, well, I told you that this was going to happen, and it's now factored in. So we went to the trading desk at T. Rowe, and the cost to borrow as a short had become very expensive. It was actually 20% to borrow the stock. The company paid a dividend, and the dividend yield had jumped to 20% that day. So basically, if you bought the stock and the stock went down 40%, you were break even, right? As long as they paid the dividend and you locked in that cost to borrow. So T. Rowe Price back then had didn't lend out their shares. So I think we made a decision to lend out our shares, earn the 20%, receive the 20% dividend, and ultimately the stock we bought back the shares that we had sold. A month or two later, I went to the Allied Capital Investor Day, not knowing, what would follow. So I show up at the Investor Day. I'm met by the management team of Allied, and they say, would you like to sit with the CEO of Allied? And I said, well, is David Einhorn here? And they said, he is. And I'm like, I want to sit with David. So they sit me down between David Einhorn and Dan Loeb. I had no idea who either of them was, that either of them would become who they are. So Dan Loeb and David Einhorn are at this. This is August of 2002. And we like sit there debating Allied Capital. I'm like, I totally agree with you guys. So they're going like, well, what about this? What about this? I'm like, no, you're totally right. And they're like, what? And I'm like, no, you're totally right. I'm like, but have you looked at this? And have you looked at this? And have you looked at this? And there was a couple of investments. The ones that they were pointing out were very undervalued, but there were a couple that were very overvalued. But I was like, there's 3 or 4 investments that are very undervalued. One was called Wyotech, which was an education company that I felt that they were holding too low. One was a CMBS portfolio that I felt was held too low. One was a company called Hillman, which I felt was held too low. And ultimately, David gave me his card. We stayed in touch. Ultimately, they ended up selling all 3 of those things over the next 2 years or so. And the stock went up probably, I don't know, from that day, maybe 80%. We received the dividends, we received the borrow, and made good money. We sold the stock. During that time, I had met Joe Mogul. I had lots of other investments, Ameritrade. I was an analyst covering Intercontinental Exchange and CME and all kinds of other...
Those are some cool businesses to cover back then.
So
a lot was unfolding, right?
Yeah, so I basically transitioned my career more into like fintech, and it was really exciting period of time. Like I met Jeff Sprecher, who's now the chairman and CEO of Intercontinental Exchange, which owns the New York Stock Exchange, right when he was pre-IPO, became his largest shareholder, still have a relationship with him and his wife. And, it was a really neat investment. Like I was the biggest bull on ICE, the biggest bull on CME, the biggest bull on NYMEX, the biggest bull on, basically all the exchanges. I mean, there were other big bulls. Like there was a group of us that were probably like 10 or 20 of us that were great people that are still some of my best friends today, that all of us made like tons of money in these stocks. And so I don't want to just say it was just me. There's about 20 of us that like just did extremely well. And Ameritrade was a unique one. So I was given sort of the online brokerage sector next, and Joe Mogul comes into the T. Rowe Price, and that's where we met. So we met probably 2001, 2002. And if Joe would go into T. Rowe Price now or to other places, he gets a pretty big audience. Back then, it was just me. And we met, and it was a $700 million market cap. When they sold to Charles Schwab today, it was a $20+ billion deal. Back then, it was a $700 million market cap, and they had $23 billion of assets. When they sold to Schwab, it was trillions of dollars of assets. So, I met with him. I believed in the story. We became the largest shareholder. And over the next couple of years, I got really interested in the idea of consolidating the online brokerage industry. I felt that there were tremendous benefits. They had done about 3 or 4 acquisitions. They bought Daytech, they bought National Discount Brokers. But TD Bank in 2004 was really focused on the idea of doing something with TD Waterhouse. They'd been speaking on their conference calls, and I kept bugging Joe regularly about saying, like, you really need to do something with TD Waterhouse. They keep talking about this on conference calls. And he's like, well, if you feel so strongly, like, talk to my board. So I eventually wrote a letter to Ameritrade's board and said, I'd like to talk to you. They got back to me and said, you can talk to us in the next board meeting. And then one day I get a phone call that says, hey, you're speaking you're speaking on Thursday. This was a Tuesday. And I didn't have a board presentation or anything ready. So I spent the next 48 hours putting together a presentation, and all of a sudden I'm in the boardroom presenting to the Ameritrade board on why they should merge with TD Waterhouse in February of 2005. And a couple months later they did, and the stock, which was trading during that presentation at like 9 or 10, opens at like $25 a share. Gets halted at like 14 and goes up to 20, 25. They pay a $6 dividend on a $10 stock, right? So a brilliant combination, basically transforms Ameritrade into basically looking a lot like Charles Schwab. And they went on to do many more acquisitions, and it was just a amazing transaction. So I get a phone call from what is now Point72, but back then was called SAC. I had really looked up to Steve Cohen, and I was promoted to run what was called the Institutional Large Cap Growth Strategy at T. Rowe Price with a guy named Rob Sharps, who's now the president and chief investment officer of T. Rowe Price. So Rob and I started running that strategy together. He was the lead, and I was his number two. And Steve recruited me and went up to Greenwich, Connecticut, and spent some time with Steve at his house and had lunch at his house. There's menus that say like "Welcome, Kyle Cerminara," and
Really?
Sitting in a room of Picassos. Like I think there was like $2 or $3 billion of Picassos in the room, and
it's a good way to wine and dine somebody.
Yeah. So you're sitting in a room full of Picassos, and I don't know if you remember this, but Steve Wynn famously stuck his elbow through a Picasso, like $140 million Picasso, maybe like 10, 15 years ago. And Steve Cohen had already bought the Picasso. Picasso basically painted 3 really famous paintings in one weekend, one on a Friday, one on a Saturday, and one on a Sunday. I'm sure I got that wrong, but that's the way I remember the story. And Steve Cohen owned the one that was painted on a Friday, and he owned the one that was painted on a Sunday, and he wanted the one that was painted on a Saturday, and Steve Wynn owned it. And if I'm getting the story wrong, I apologize, but I think it's pretty close to accurate. And he paid like something like $140 million for it. Maybe it's 120, whatever, but it was close to like $140 million. And Steve Wynn was having like a party at his apartment in Las Vegas, and I guess like it was a crowded room, and he accidentally bumped into the Picasso.
How in the hell does that happen?
I don't know, but like when you have a lot of Picassos and you have a crowded room, like you sometimes stick your elbow through a Picasso.
Yeah, so, I guess I wouldn't have the crowded room around
Google
the Picassos.
Steve Wynn Picasso elbow or something, whatever. You'll see like this.
I mean, I vaguely remember this story. It's just shocking to hear it out loud.
Yeah, so I'm sitting having, lunch in the room where the Friday Picasso and the Sunday Picasso is, and I'm like, well, where's the Saturday Picasso? I want to see the Saturday one. And of course, it's being fixed by, apparently there's people that fix Picassos, when people stick their elbows through it. So
right, it sounds like a lot of downtime and then some very important uptime.
Yeah. So 30 minutes into my conversation with Steve, he's like, well, when are you going to start? And I'm like, what do you mean? I'm like, I work at T. Rowe Price. And he's like, no, you're coming to work here. And he's like, we'll work out the details. And I was like, no, you don't understand. Like, I'm happy at T. Rowe. And he's like, nope, you're coming to work for me. So sure enough, like 2 weeks later, I worked for Steve and we worked out the details. And working for Steve was one of the greatest periods of my life. I learned more in that 4-year period than
What years were these, just to frame it a little bit?
So I worked for Steve 2007, 2008, 2009, and then 11 and 12. So I took a little
sabbatical.
So I left and then came back. And I worked for him during the financial crisis. I sat back to back with him, literally like 3 elbow to elbow with him during the financial crisis. And he's one of the most brilliant minds ever to live. And I know that he takes some personal heat right now, but it's not, I personally think, that just comes with the territory, but it's probably not justified. I learned so much from him. I'm grateful to him for the time I spent there. I still have a good relationship with him, and as do most people that worked for him. But it's amazing how few people that worked for him will say bad things about him, because he's actually a good guy. He's tough. He works harder than anyone that I've ever worked with. He is a around-the-clock guy. He's got an amazing memory. If you took Steve and put him on an island with a Bloomberg and no information besides charts, he would turn $1 million into $1 billion. Like, he is that
really
good. Yeah, he doesn't need information. People think he needs information. He is so good. He is that good. And
how do you even? I don't even know how you would articulate what that good means, but like, why, what is it that he sees, and why did you use charts, for instance, when you were telling that story? Is he that technically driven?
I would say I wouldn't want to talk for him, but he's very technically driven. So
well, yeah.
He uses fundamentals and technicals.
You said that he would have a Bloomberg in your hypotheticals.
Yeah.
So it's not as if he's not doing any fundamental research. I just thought it was interesting that you mentioned charts.
Yeah, well, so the Bloomberg actually is more technical than fundamental. Yeah. He uses a lot of technicals in Bloomberg. So he is really good with technicals, but he's also amazing at seeing news and knowing what to do with it better than anyone. So like if you see a headline, all of us will say, well, what does this mean?
Yeah.
Steve doesn't say, what does this mean? I mean, he does, but he knows what it means. He knows exactly what to do better than anyone. And then if it doesn't do what he thought it was going to do, he corrects quickly. He's so good, and he's the best. Like, I think he's the best ever. And I think that he's been, I think one of the things that, and this is something that maybe I need to learn, and partly why I'm speaking today, is that I think that I've focused so much time on doing rather than communicating. Like, there's some people that promote and there's some people that do. And sometimes promoting results in like favorable outcomes for stock prices, whereas doing might result in favorable outcomes for things that you're trying to do. It doesn't always, like you can't always like have great outcomes just because you do, because like sometimes there's bad luck, sometimes there's just bad circumstances. Some people spend like almost all their time promoting, and I spend very little bit of my time promoting. And I've really learned that like people want to hear what you're doing. I think Steve spent like almost no time communicating with people for a long time. It's amazing to me that he now has a Twitter account. Now that went away for a month because people attacked him, but now he's back. And I think communicating is really, like, I found it's actually much more important than I realized. And I guess I was blind to that. But, communicating is, much more important than I realized. And people want to know what you're doing and need to, so that's why I've sort of asked the question of like, what are the best ways to communicate and how would you like to hear? And you started the question of, who are you? How should I refer to you? Like, are you, and I said, well, I'm the founder and CEO of Fundamental Global, and we have portfolio companies. And I have multiple audiences, right? Like, I've got Fundamental Global. Fundamental Global has some limited partners. We used to own a wealth management company called Capital Wealth Advisors. We actually have divested of that now. I no longer have any interest in Capital Wealth Advisors. We grew it from nothing to $2 billion, almost $2 billion of assets under management. I'm no longer involved. I'm no longer the chief investment officer. Sort of back to the focus thing. Like, I used to have to be responsible for communicating with those several thousand clients. I no longer need to. Fundamental Global has some limited partners. Directionally, we're going in the direction of, for the people that own the 4 positions I mentioned, we don't charge them fees anymore. They're basically Joe Moglia, his family, me, my family, and some very close friends and family. So it's just like, I want to make them money. I don't really want to charge them fees.
So I'm going to interject real quick, just so you know my thoughts, even though who cares what I have to say, but I'm going to say it. So, I mean, as somebody that probably over communicates, I would argue part of what I'm doing is communication, at least. And what I'm trying to do is sort of intertwined, right? I think it's hard to watch what Buffett has built and not at least understand some of the game that he was playing through his communications, right? And some of that, I think, like, one of the things that I admire about him from a business perspective is I think he threaded the needle really well between being, I mean, I don't want to say promotional, but if you watch the annual meetings and how he went about his business, it's impossible to not think that his communication has something to do with his deal flow, right? And he was carefully crafting an image that he thought would not only benefit him, but also his stakeholders. And I think that sort of what we're doing, or, what I'm doing, is my version of something similar. And I guess that where I draw the distinction is I think that there are some people that I look at and I say, okay, well, judging from what I think I know from the outside, which is obviously limited, is that method of promotion something that I'm comfortable with? And a lot of the times when I see promotion in finance, I get uncomfortable. But fundamentally, I think that there's a benefit to communication that I guess I would just say that there's a gray area. I try to toe the line towards, I have a soft spot in my heart for retail and individual investors, right? I'm self-taught. I didn't go through a training hedge fund, a training program at a hedge fund or anything like that. So I just try to make sure that I do my part to try to keep people away from the shills to the best of my ability. But, I don't know. I do err on the side of, I'm basically trying to start a media thing here. I don't know how that all ends up, but to argue that communication isn't core to that strategy would be pretty flawed reasoning.
No, I agree. And back to what you were saying about Buffett. So I've observed it, and I was actually I've gone to almost every annual meeting since 2007. And I look back on one that I went to maybe 3 or 4 years ago. I was sitting there, and Warren and Charlie were saying something about how they were talking about their first 5 years and how they were running around and they were doing deals and they were buying beaten down companies inside of Berkshire, and they were just exhausted and tired, and they sort of had this view of like, let's just buy high quality companies with great management teams and let them do all the work instead of doing these like big turnarounds inside of it. And I was sitting there like, oh my gosh, like they're talking to me. Like, did they say that? And I was just like, yeah, like that would be easier. I'm like, because I'm working way too hard and everyone's just like criticizing me. And I'm like, don't they know what I'm going through? Like how miserable this is? And I'm like, I'd much rather be spending time with my family and my kids. I could just walk away, but I feel like I have an obligation to just finish this. And it's just like, all right, well, people can be kind of cruel, but like when you're in the middle of trying to turn something around, it's easy to be like, oh, you should just go and communicate. But it's just like, oh my gosh, like when? It's like, yeah. I was in the office till 2 a.m. last night. I worked every weekend for the last 5 years. Like, when would you like me to do this?
Yeah.
So it's just like, it's a lot. And what I realized is like the reason they were able to do it so successfully is because they basically decided to make their lives easier by buying things that just sort of are on autopilot and then spending all their time communicating, right?
Yeah.
They basically became communicators. And
Yeah, and I think that they also, at least from my perspective, did a pretty good job at framing when they were open to communicate and when they were closed. So it wasn't something that there was any expectation, at least from the minority shareholders, that you would hear much from them until the Ks and Qs dropped and then the annual meeting. And then I'm sure for the deal flow, they were fully open, but for ideas and stuff like that, they were always open.
Well, you say that, but they're also regularly on TV. Like, not
yeah,
now.
That's fair.
Yeah.
Yeah, it's interesting. The only word that I can think of is like metagame, but I don't know that that's the right way to frame it or even that I want to say it that way. But I do talk to some people that I know that are pretty good at media. And there's like, look, what I'll tell you is it's really powerful to have people that are rooting for me to do well. And it's powerful to have people that say, like, thank you for doing this podcast. Here's how I can help you in certain ways, right? And it comes in different forms. Like, I was talking about supply chain the other day, and somebody that follows me and listens to the podcast and works at some docs said, you just told me, like, I'm happy to hop on the phone with you and tell you what I see that's going on, right? And like my personality does better when I'm talking to people and doing the scuttlebutt part of the job. And this method of communication has so much scale to it that it facilitates inbounds that as long as like people are thoughtful, I'll give anybody the time, right? And it's been really nice to hear from people, and what I get like personally out of it is a lot of people are like, dude, thank you for doing this because I'm learning a lot from it. I wouldn't know what to do if it wasn't between this and this other show that I do that's called Value After Hours. Like I think I'm helping some people, and in doing so, sort of they're trying to help me out too, right? So I don't know where the world's going. I don't know how much downside you have from social media, or I should have I have or whatever. But the benefits that I've seen have exceeded the cost so much that, I don't know, maybe it's because I don't have the network that some other people had coming out of college, right? And this is kind of my way of building out the network, but it's really worked for me, and I'm really grateful that people are listening and enjoying themselves. And I get a lot of benefit too.
Yep, no, for sure.
So back to your experience, when you heard Warren and Charlie talking, were you into the Ballantine? You went activist on Ballantine in 2014, is that fair?
It's fair, but it wasn't. I'm not a big believer in going activist. As I'm an activist, but I don't. You learn a lot over a period of time, and I think activism is disruptive. I didn't want to go activist on Ballantine, but I wanted to be active in Ballantine. So
okay.
there's a difference.
Yeah, like constructive as opposed to just passive.
Yeah, so I met Ballantine, and I left 120 voicemails for Ballantine before they called me back. I sent dozens of emails before they responded to an email. I just kept calling and emailing, and no one would call me back. And I filed a 13D showing 14% ownership, and they wouldn't talk to me. And I'm like, I'm your largest shareholder. You won't speak to me.
Why did you buy such a large stake when they wouldn't even speak to you?
Because I had such a great margin of safety in the company from the financials. So I felt like very good about the margin of safety. I had done tons of work on the company, and who was running it was irrelevant to me. I mean, it was part of the equation, but it wasn't necessary. I felt like the Graham and Dodd nature of it was good enough that it was so undervalued that I wasn't concerned about the management. I wanted the management to be good. I mean, looking back on it, it's a great question. If I could do it over again, I probably would have spent a lot of time with management, because some of the things they did, for example, buying Convergent, cost me lots of time and money. And I would have stopped them from buying Convergent.
For those that don't know, Ballantine was, you bought the screen business, right? It's like a movie screen business. It's got an exclusive with IMAX. And
yes, so the movie screen business, you wouldn't know it now but it's a wonderful business. Like, it's a nice cash flowing business. Should it be a public business? That's a great question. But it's a wonderful, like, little cash flowing business. The former board went out and bought a company called Convergent from Sony when it had over 40 million of revenue. By the time I joined the board, it had 17 million of revenue. So they crashed revenue from 40 to 17. It was losing tons of money, and the value of the business, like, it was all non-recurring revenue. It was a disaster by the time I got there. And I knew that when I joined the board. So I was inheriting like a mess. And this is one thing I'd caution people, is that when an activist takes over a microcap company, you should expect like the next 2 to 3 years are going to be a total disaster. Like, if that activist is good and knows what they're doing, because they're basically going to take over like the sins of the past. The sins of the past are bad management teams don't write off bad inventory. Bad management teams don't write off bad accounts receivable. Bad management teams don't make the tough decisions to do things that they need to do. People criticize me for doing the things that are the right decisions. Like, I've done we made the right decisions, and that's why we were able to sell Convergent for 23 million, because we made the right decisions. We made things that were valuable. Along the way, people are like, "Oh, you're destroying the company." It's like, "Oh wait, then why did we sell Convergent for 23 million then?" Would I have loved for COVID not to have hit our cinema business? Yes. But our cinema business was extremely valuable prior to COVID. I mean, like, very, very valuable. And Ballantine Strong announced prior to COVID, I think it was, I don't know, maybe a year before COVID, that we were contemplating strategic alternatives for all three businesses. We had three businesses: Strong Entertainment, Convergent, and Strong Outdoor. And then we also had some strategic investments: Green First, which was called Itasca Capital; FGF, which was called 1347 Property Insurance Holdings.
And Strong Outdoor was a sign business, right, on the top of taxi cabs, more or less?
Taxi
Is that fair?
Uber, yeah, exactly. Yeah. Taxis and Ubers. And there's a story behind each of those. But if you starting with Ballantine Strong. Ballantine Strong was a company that was in the cinema industry for close to 100 years. And that cinema business has evolved over a long period of time. When I got there, it's the number one manufacturer of movie screens in North America. We have a 80 some thousand square foot plant up in Joliet, Quebec, which is a really neat town if you ever want to go up and visit it. It's really cool. No one speaks, yeah, I shouldn't say no one. Very few people speak English in Joliet. So if you go out to lunch or dinner there, bring your French translator.
That's nice. So you like keep the culture in a town like that.
Oh, it's amazing. Like you feel like you're in France. It's even, I would say there are fewer people speak English in Joliet than in France. Like it is like really out there. And it's just a really neat town on a river and just a wonderful people there. And, so we have a neat little factory up there. It's a factory town and wonderful, loyal employees that have worked for a long period of time for the company. We have our own proprietary paint, which is like the secret sauce behind making movie screens, part of the secret sauce. So there's only one competitor in the world that really can make a quality movie screen like we can. It's called Harkness. They're based in Ireland. And they dominate Europe. We dominate North America. And we share
shipping costs are just too darn high, right? I mean,
They're
how
high.
would you ship an IMAX screen?
Well, so we ship IMAX screens because we make every IMAX screen in the world. So
Yeah.
every IMAX screen in the world is made by us. Without going into like all the details of like an IMAX screen, there's no one in the world that can make the quality of a screen like strong. And IMAX has partnered with us, on that for like 20 years. And,
You
it's
ship
very
it in pieces?
Nope.
You have to?
No, it's rolled.
One screen.
It's rolled.
Okay. That's amazing.
Yeah, it's rolled, and it's typically done on a large boat. But if it needs to be there fast, it's and look, Strong now has a facility in China. Now we don't have any of our intellectual property there. It's all of our intellectual property is in Quebec, but it's a wonderful business where we make very good money, but it's not like a massive growth business. Like there's opportunities to grow. We can grow into Europe. We can grow, but cash flow is nice. So. Yeah, that's why we have Green First, right? Like we had all this cash, and it's like, well, what do we do? So we made a $2 or $3 million investment in Itasca Capital, which became Green First, and that $2 or $3 million investment is now worth $17 million. Like, shame on us. Sorry. The former board took that money and bought Convergent. That was their mistake. They used a lot of that cash to buy Convergent. By the time I got here, they kind of destroyed Convergent, and I had to fix it and then sell it. But it took us a while to fix it, so that was tough. We also had a business called Strong Outdoor, which was a business that spun out of Convergent. And we basically had some digital signs that we were using in Convergent. And we decided to build a business putting those digital signs on top of taxis. And, we saw Google Ventures partnering with a company called Firefly. Really smart Stanford MBAs, received $50+ million in venture money, most notably from Google Ventures and NFX and a few others. And we said, you know what? They're super well funded. They're brilliant. They've got great technology. They're aggressive. Like they're talking about like the things that Uber did, like that they're going to do the same things. We should own shares of them. We like these guys rather than compete with them. So I was like, you know what? I don't want to compete with these guys. I want to own them. So I called them up and I was like, or one of my employees called them and said, why don't we partner? And we put together a deal and we said, you know what? We don't want to sell to you for cash. They had lots of cash. We said we'd rather sell for stock because we see huge upside here. So we took a convertible preferred, and the preferred nature of it protects us to the downside, meaning that if for some reason they sold for less than the value of the common stock, we get our $13 million principal back, but we can convert into common stock to the upside. So we have downside protection in the preferred. We have upside, where we can convert into common at the value of the common at the most recent round. So we like that. And, it's a typical venture deal, and it's got the risks of a venture deal. It's got the upside of a venture deal as well. So,
it's a cool concept. It's digital signage that you're going to be able, like an Uber driver would be able to put on top of their Uber, and then it's like geo-located advertising. Is that accurate?
Yeah, so think of it this way, and this is how I got really excited about it, was think about a company that's got a couple thousand screens globally in major cities. New York City is the best city in the world for digital out-of-home advertising, but they're in New York and San Francisco, LA, I don't remember all the cities, but it's like Dallas and Vegas and Miami and wherever, right? Chicago. And Metcalfe's law is the value of a network is the square of its nodes. It's why eBay is valuable and other online auctions are not. It's why the Chicago Mercantile Exchange is valuable and why other platforms are not. It's why, all right, so Metcalfe's law is like when you add nodes to a network, it becomes valuable. Visa and MasterCard are valuable because when you have a Visa, you can use it in anywhere in the world. When you have a Discover card, or Discover is valuable, but not as valuable as Visa, right? Because you can't use your Discover card. And Diners Club International is less valuable than Visa because when you go,
were you one of the early ones to figure this out with the exchanges?
Yeah, it's Metcalfe's law. So you add nodes to your network, and it's valuable. It's why Facebook is valuable. It's why
does it decline after a certain critical mass?
Nope.
Really?
Metcalfe's law, it's exponential. The more nodes you add, the more exponential in value.
That makes sense. It just seems like you would get to an incremental point of diminishing marginal return, but...
No, it actually accelerates. Each node adds more value. I mean, that's a math exercise that I have to think through what you're saying. So
yeah, like at Facebook scale, for instance, the next user seems like you've sort of hit the scale that you need, but I'm sure mathematically I'm wrong.
Well, mathematically you might be right. I need to think through that. But the whole concept of when a network is growing fast at the beginning, 2 nodes is more valuable than 1.
No, 100%. I can totally understand that.
You get to several tens of thousands of nodes on an advertising network, and you have amazing software and technology, and you make it available to advertisers, and then you make it programmatically available. And you think about YouTube, all the different types of ways that Google allows you to advertise through YouTube, through Google Search, through other ways. And then you make Firefly one of those options. You can see how valuable that could be if you can advertise on YouTube, you can advertise on Firefly, you can advertise on Google Search, you can advertise in other ways. So that's the holy grail.
Makes sense why Google would want to partner with them, right?
You can see, yeah, so it's an advertising network, right?
Yeah.
And it's an advertising network that becomes extremely valuable when you add nodes. So in order to make it valuable, you have to add nodes, and that's the future that I see is they add nodes. They have their own proprietary screens. Their screens have all kinds of embedded technology that goes beyond advertising. They have weather forecasting inside of it, right? Because they've got these moving vehicles that have, there's all kinds of data they can collect. They can collect traffic patterns, right? That they can use for all kinds of interesting information. Like think about Google Maps, right? Google Maps can use that information for all kinds of interesting things. So there's all kinds of information that you can use from the information that's being generated from Firefly. So we haven't gotten to that point. Right now it's an advertising network, but there's embedded technology inside of those digital signs that goes far beyond just advertising. And we intend to use it.
That's cool. That's cool to be a part of.
Yeah.
It's a lot different than just like a print sign on a, I think everybody, well, I shouldn't say everybody. I associate just like a dumb sign on a taxi, right? But once you start to flip that to a smart sign, things can start to get kind of powerful.
Exactly. And I was on the board of a company called Iteris, and they do some of the stuff, with smart cities. And I think smart cities are really an interesting future. So the whole Internet of Things, this is a neat play. So
that's cool.
So that's, Ballantyne Strong's got some really interesting pieces. It's got a lot of cash right now. We have an interesting investment in GreenFirst. We have an interesting investment in Firefly. We have an interesting investment in FG Financial. And then we have the cinema business that, we mentioned that we were exploring all kinds of different alternatives for it. Publicly, we reiterated that in every conference call for a while. You can assume that we do what we say. So you can assume that I sort of ruined my life for a couple of years. And, deals take time. Like they don't happen like in 2 weeks. It's so funny, like watching people on Twitter, like bossing, CEOs around, acting like you can put like an M&A transaction together tomorrow. Like these things take time and finding the right partner. And you can assume that we know how to do this stuff and we tried to, and that there were lots of interesting deals that probably almost got done and then COVID hit, right? And so
yeah,
I wouldn't want to say that a deal was almost done, but COVID hit, right? So it hit. What do you want? Things will come back. And they're already starting to. Google IMAX CEO forecast for the cinema industry, he's already like extremely bullish. We had the biggest Chinese New Year. But look, I'm not obsessively focused on like what the cinema industry does. I'm focused on building value for each of these companies long term. One of the things I realized is that people really want to have a focused bet on each of these companies. So the nice thing about having multiple public companies is that we can have one play in each. People have said, well, why don't you merge all of them together? It's like, well, people don't want that, right? Like
yeah, and
people,
then you'd have to do the trackers. Then you'd be like Malone.
Yeah, and we thought about that. But like, look, Malone does trackers because he's huge. Yeah. Right. And we've looked at doing trackers and it's complicated and expensive. And then, so when you look at doing trackers, you spend money on legal fees. There's only like one or two attorneys in the world that know how to do trackers. And it's like, they're expensive and they're all, retiring.
They all work for Malone.
They all work for Malone and expensive. And at some point you say, you know what? It's like, okay, so we're spending money on attorneys. Like, let's focus on like, actually, it's a better idea to just make each of these companies bigger. Right. So we've talked about it's expensive to liquidate a company. Companies need to be bigger to justify their existence. So I think a focused strategy in each of these public companies makes sense, which is why Green First is focused on timber. BK Technologies is a really interesting focus on public safety and technology. BK used to be called Realm Wireless. It was a mess when we got there. I mean, when I say mess, I'm underestimating it. Like, it was a mess. We spent years cleaning it up. We changed the name to BK. We created a holding company. We cleaned up inventory. We brought in a whole new technology team. We've reinvented all the products. It is awesome now. Like, what we've done with the company, I'm so proud of it. I mean, the things we did for that company, like, that are so underappreciated. And it's painful to like watch people talk about, oh, you're such a deadbeat, or like, it's just like, are you kidding me? Like, do you know like what we've done for some of these companies, what they were in? And quite frankly, maybe like people.
Well, so here's a devil's advocate real quick. Do you think it would be a fair criticism to say that maybe you underestimated the size of the headache that you were incurring when you made some of these acquisitions?
Oh, for sure. So Magnatech, it was extremely well managed, amazing management team, amazing business, amazing cash flow, and we caught the secular tailwind, right? So management team was awesome. Everything sort of like went our way. And the business was improving, and we had a stalking horse buyer, and it's like, wow, that was easy. But you know what? There were scary moments there too. It all looks so good from the outside, but I lost lots of sleep on Magnatech on the inside too, right? So there were days where I was like, whoa, this is scary. I mean, it sold July 27th, 2015, my birthday. And a couple weeks before that, I was like, oh, this is terrible. Like, I mean, that deal fell apart many times. Everything.
How much of your net worth was in it? Just, you don't have to say like exactly. I'm just trying to get a sense of your sleepless nights and how like tied your family was to it. It was
like 10, 15%. So, yeah. I mean, it wasn't like.
It's a good amount. You don't want it to just like shit the bed.
To me, it was just a very critical investment, and I wanted to see it do well. Like, regardless of how much of my net worth was in it, I wanted it to do well. Like, I had lots of other people's money in it too, and I wanted them to do well. Like, I had my parents' money in it. I had my family's money in it. I had friends. I want those people to do well too. Like, it's not just me. Sometimes I lose more sleep over like my friends' money than mine, right? It's not just about my money, it's about my friend's money. If I lose money for my friend, I'm like more upset than if I lost my own money. I mean, my wife gets mad about that, but so
no, that I understand.
Like, I was asking about how I can personally take the pain. I can personally take the pain better than my friends can. Like, it's like when you lose money for a friend, it's like, oh. When you lose money for yourself, it's like, whatever, I'll deal.
Yeah. I was only asking about how much because I've only been close to one friend that's run his own sale process. And he had bet everything twice. And watching him on the second one, it was an oil E&P company. Man, I'll tell you what, it was right before the oil crashed, and he was going to flip to a public company, and he was going to be locked up. And he was like losing sleep like crazy. He was just like, I don't want stock. I want cash. I want my employees to have cash. Like, I do not want to get locked up. And it was just kind of interesting to watch him. I mean, that was it's funny when it was over. he said, I'm either going to retire for a while or do it again. And I was like, oh, you're crazy if you don't do it again. And now that he's been retired for 4 or 5 years or whatever, and seeing him happy, I understand how dumb I was on the outside saying like, yeah, just go do it again. Because I finally started listening to him when he was saying, do you understand how stressful this is for me? Like, I don't do anything except for this. What he was doing, he was a landman at his company. So he's flying around to like parts of Texas that you may not want to go to for a vacation, right? So, and then all the stress of having the employees, like you said, I mean, he was in it for the other people, not so much for himself.
Yeah, and it's not just also investing people's money. It's also like people don't realize this. Like when you work for someone else, you can just quit, right? When you start your own company and you hire employees and you have people that it's like it's painful to have to think about the consequences of these people work for you and they came and bet on you, and if you let them down, they're not going to have jobs. And those are the kinds of things you lose sleep at night on. Like you're losing money for your family, you're losing money for your friends. If this doesn't work out, you're potentially losing jobs for people that left secure jobs to come work for you. Like it is all on your back. So, but it all worked out. So,
do you ever regret leaving the hedge fund industry? Would it have been a less stressful life?
No, like I'm doing what I want to do. Like I would, my wife always pushes me and says like, why don't you just manage your own money and not do this? And, like I think you've mentioned Mike Mitchell once or twice, and, he seems to have like the most ideal life.
Yeah,
like why don't I just
Mike's
do that?
playing his cards well right now.
Yeah, like I'm doing all the work and he's
letting crazy people on Twitter pitch him ideas like Curate, and then he's outsourced some of it to you too. He's doing it smarter. He's working smarter, not harder.
That's probably what I should do, but for some reason, like I have, and Mike's super talented and smart guy, and I met him a few years ago and like him a lot, and he reached out to me and asked me about Itasca Capital a few years ago because it was trading actually it was not even Itasca Capital, it was PIH, and it was trading at a discount, and we started talking, and it sounds like he's made some money on some of these stocks. So
what's going on with this insurance company you got that had to relocate to Florida? What happened and all that? Like how many of these, like, okay, here's my real question. Value investors, I think, see Buffett, hear the word insurance, say, I want to do that myself, and then get themselves into, I have heard of a couple people getting themselves into situations and being like, oh shit, this is way more complicated than it looked underwriting. Was that the case with the insurance company too, or not really?
Sort of. So
I'm not saying that that's what you've done. I hear it pitched a lot, and I'm like, I'm not sure that I want to get involved in that.
Look, Buffett has a great setup on the insurance side. Others do as well, like Markel, Fairfax. Insurance is an interesting business, but it's hard. Insurance is a hard business. Like you have to really understand it, and it's not as easy as people think it is. So like this whole idea that you can just buy an insurance company and manage its float is a fallacy. We have a lot of insurance expertise. We understand the business. I've been a financials guy since 2001, right? Like I've been looking at financials my whole life. Larry Sweats is probably one of the smartest insurance people you'll meet. His background is really on like distressed, difficult situation insurance companies. So he really knows how to deal with like an insurance company that's got problems. And he's done really well with those types of situations and knows how to handle them. But the interesting thing about insurance is what I found is that in the US, it's different state by state. So every state matters. The regulators matter. It's a very political situation. It's very much in control of like what the regulator thinks about your particular situation. So, you have to write policies in the US. Like you can't just stop writing policies. You have to ask for permission to raise pricing. So you can't just raise pricing. So pricing is controlled. You can get away with raising pricing if you ask for permission, but your investment portfolio is very much, there are regulatory guidelines about what you can do state by state. And there's certain states that are good, there's certain states that are bad, and you really have to be careful. We thought the insurance business was interesting. We still think it's interesting. I think reinsurance is very interesting as well, but you have to be very careful and you have to be very knowledgeable. And I'd be very careful for people thinking they can do it if they have no experience. So,
I mean, you see some of the greatest that have ever, like reinsurance particularly has gotten some people in a jam, right?
Yeah,
so reinsurance
reinsurance is a dangerous term because it means so many different things and people try and make it sound like it's one thing. And the types of reinsurance we're writing are, like, I hate to trying to characterize it as one thing because it's not, right? So we look at bets that we think are prudent. We try and cap the losses, right? So we say, this is the amount of money we're willing to lose, right? So we're willing to lose $1.5 million, right? And no more. If you think about what a rating is, a rating from Moody's or S&P or other rating agencies is technically like a license, not a license. It's the idea that they're saying that you are creditworthy and therefore you can borrow money, right? So it's sort of like a measure of creditworthiness. And people don't think about that, right? It's a measure of creditworthiness. They think about it when they think about it with bonds, but they don't think about it when they are thinking about their insurance company. And the whole idea behind having a credit rating as an insurance company is that you can borrow. And borrowing in the context of an insurance company is putting on liabilities, which are insurance liabilities, right? If you put on lots of insurance liabilities, the more you put on, the more you can lose, which is why you get downgraded. And then once you get downgraded, you can, then your business is over. So we are not a rated reinsurance company, which means we have to post collateral. Since we have to post collateral, like, we can't lose that much. Yeah, we can lose. I mean, I don't want to suggest that we can't lose. We can lose, but we are very careful with the amount that we can lose relative to if we were writing really risky reinsurance, which makes it possible to take a little bit more risk on the investment side because of the way we're writing the reinsurance. If we were taking, huge risk on the reinsurance side, then we wouldn't be able to take as much risk on the investment side. So it's a little bit better on the investment side because of the reinsurance that we're writing. We were taking, in Florida, Louisiana, and Texas, we were taking large insurance risk, and therefore we couldn't take large investment risk, right? We had to, minimize it. So it's the risk you take in the insurance portfolio on the insurance liabilities is directly tied to the risk you can take on the investment side. And if you take too much risk on the insurance side, then you can't take much risk on the investment side, and vice versa.
Yeah, that makes sense. Well, man, I don't want to take up too much of your time because I know that you're busy and working around the clock. So I'm just going to kick it to you and say, I don't know if there's anything that you want to cover off on. I don't know if you want to do a quick SPAC lesson or not.
Well, let's talk about SPACs for a second. So I read a lot about people talking about SPACs and sort of saying that this is sort of a hot new trend that's going to go away. And SPACs have been around for a long time. They've been around for, 20 plus years. And they've only recently become mainstream, in the last, call it 12 months or so. So big name people are doing SPACs now. And I think in some cases, too many people are doing SPACs, right? So some people that should, celebrities and others that like really have probably no business doing SPACs or doing anything in business are doing SPACs. And I don't mean that to be a jerk.
Yeah, it's just what's going on.
I'm just saying, like, there's certain people that are doing SPACs that, like, Joe Moglia was the chairman and CEO of TD Ameritrade for 19 years, did 11 acquisitions that were all very successful, took a $700 million market cap and turned it into a $20 billion market cap. You look back at the track record on those 11 acquisitions, and they were all very well thought out. They were all very successful. He has a great reputation, and he ultimately sold Ameritrade to Schwab. I was his largest investor for many of those years. I've been his partner since 2012. We have a great relationship. I've been involved in many of the strategic decisions he's made over the years, and we now have a SPAC together, FG New America. We bought a company called OppFi. We're under definitive agreement. That deal, we filed our proxy. That deal should close sometime in June of 2021 and trades under the ticker FGNA. You look at it, it's a comparable company to Upstart. UPST is the ticker. Upstart's stock has gone from 20 to 140 in the last short period of time. amazing. I was watching a video of Upstart CEO talking about his business, and I'm like, this is a very similar business to ours. Their business is trading like 24 times revenue. Ours is trading like 2-3 times revenue. And it's very interesting to me, sort of the valuation disparity. And that comes back to like communications of like what you were saying. It's like they're communicating and we probably should do a better job of that. So we will. And, sort of just getting the message out of like what our business is and what their business is and how we're similar and how we're different. And there's many similarities and there's some differences. And I think it's important to highlight both of those. But when you look at the SPAC market, there's a lot of SPACs out there. There's some questionable deals being done. Like I think when we looked at the number of deals that were done, I think, and don't quote me on this, but it's like hundreds of SPACs have come public. I think like something like 60, 70 deals have been, announced of those. And I think there was like 7 companies were profitable, right, of those deals. I think when we looked at those numbers, our OppFi was either the most profitable or like one of the most profitable SPAC transactions announced. So it was like I thought it was a very good deal, 10 times like 2023 earnings or something like that. So pretty reasonable numbers. Like we actually are very profitable in 2021. We're profitable in 2019, 18. So like there's a lot of discussion about like companies that are not profitable. And I think that's fair. That's fair criticism. One thing I do think though is that there's a discussion about like the SPAC market is sort of this fad that's going to go away, or that like I see people saying, well, it's like, I think the SPAC market is here to stay for a couple of reasons. One is I think it'll come and go. Like it's cooling a little bit right now. You see that just like the IPO market, it'll cool. It'll heat up again. It'll cool. It'll heat up again. Like that's normal for capital markets. So like it's not fair to say like when it cools off that like it's dead, or like
yeah.
the IPO market cools all the time too. Like it's not dead just because it cools. It's a viable alternative to the IPO market, and the IPO market's not dead. It's here to stay too. But companies that are considering going public have to evaluate, should we go the traditional way or should we go the SPAC way? And there's benefits to both. One's not better than the other. It depends on the circumstances for each. So there's cash costs, much more cash costs potentially with going the IPO route. There's constraints with going on the IPO route that don't exist with the SPAC route. With SPACs, like there's things that you can do, like give forward projections, that some better disclosures, different structuring that you can do with a SPAC that you can't do with an IPO. There's things with the IPO that you can do that you can't do with the SPAC. So like there's benefits of both.
What would be a benefit of an IPO that you couldn't do with a SPAC?
With an IPO, the company is basically marketing itself immediately, whereas with a SPAC, if you're a company looking to go public, you're basically not negotiating an M&A transaction with a SPAC, right? So you're just basically saying like, we're on our own, we're going to go public, and we're not going to deal with sort of like the confusion around founder shares and warrants and so on. We're just going to have a nice, clean IPO and be public. With a SPAC, there's sort of the whole period of time where you're closing a transaction where there's some confusion. And I think that some of that's the opportunity, right? So there is a period of time where you market the SPAC and you explain the deal, but if you don't do a great job with that communications process, it creates sort of a valuation gap between the IPO and the SPAC. Like in the IPO,
because the IPO
market,
can do the whole road show and really like drum up interest, and it's very very mechanized, right? You've got investment bankers that are driving the process.
And then the sell side's launching, sort of their sell side reports on the IPO, like right afterwards, and initiating coverage. That will happen with the SPAC too, but there's positives and negatives to both.
But the sell side's not going to get ramped up unless there's like M&A opportunities, right, for the SPAC. Like for instance, you take a SPAC public, the sell side's not like incented in the same way to initiate coverage and get all amped up about that entity. Is that fair, or am I too cynical there?
It's a good question, and I think it's probably fair. I do think that you do have sell side coverage on both sides. So like I think that there is I hate to sound like I believe the laws actually exist, but I do think that there is a pretty decent separation, and that research analysts do cover what they want to these days, and they put their, like at the bigger firms, like the ratings are the ratings. And if you look at Upstart, for example, like some of the analysts that rolled out coverage from the big banks came out with hold ratings, and they didn't pump the stock, for example. So, I think that there is some reason, like people were putting, but they got it wrong, right? Like they put $50 targets and the stock's at 140. So they probably would have been better off putting buy ratings.
As someone that's like really been in the center of that, like of Wall Street for a while, do you defer when you see a share price rocket like that? Do you defer to the market, or does your gut say maybe things are a little bit too heated here? Right? Because you read a lot about like, oh, unprofitable companies and they're everybody's buying them, but there's another side of that where unprofitable could be investing through the income statement for the future, right? So it's not quite as easy as people might like to say.
So I started my career at T. Rowe Price where I understand. So I've had the benefit of 3 different firms that are 3 different strategies. And I understand why stocks trade the way they trade. Like I understand why Tesla trades the way Tesla trades. And I think FinTwit is universally too negative on things like Tesla and all the things that are sort of the go-go like stocks of the technology stocks. I think FinTwit's unnecessary. Now there's things that have no revenue that are trading at multi-billion-dollar valuations. I totally understand why people don't like those. But there are companies that are technology companies that have real revenue that are legitimate. Like I was bullish on Amazon in 98 and people thought I was insane. And I was like, okay, I think I'm insane. And I was bullish on Tesla like years ago. Yes, Mike Mitchell. I was like, people are way too negative on Tesla. This is like 2 years ago. I mentioned this to him. I was like, I want to say something controversial to you and I don't want you to think that I'm a jerk. I was like, I actually like Tesla. And he's like, I don't think you're a jerk. And I'm like, okay. I was like, but I think Tesla could be a good investment. And this is like 2 years ago. And I felt bad saying it. But on the other hand, I understand.
Why did you feel bad saying it? Because everybody was so
because everyone
negative about
hated it. Yeah. And I was like, I think people are way too negative on this. I was like, it's like Elon Musk is like brilliant. And I had already owned 2 Teslas myself. And I was like, this is like an iPhone. This isn't
they are pretty cool cars.
This is like an amazing vehicle. But look, it's now at this valuation, I have no idea.
He messes around with the SEC sometimes, right? So it's like some of it's in how you deliver the message. And then the other side of it's like, that guy's a genius. It's changing the world. And I'm a guy in a room. So who am I?
Right. Yeah. I think that universally, like people, there's reasons to be skeptical, and then there's reasons like if a company has 10 million of revenue and a $2 billion market cap and it's going to the moon, it's going to Mars or whatever, and it has no revenue, that's probably a reason to be skeptical. If it's got like a product that you love, like the Peter Lynch, principles of like, I love this product and it's trading at like 40 times earnings, but I love this product and it's growing like 30% a year, like it's probably okay to buy. Like, I don't know, like if you love the product, I'm not recommending anything, but like I'm saying like...
Yeah, well, you've seen that growth mindset and you implemented that at a firm, right? So that's why I'm sort of asking. Yeah,
like you don't, at T. Rowe, like you don't have to be like, oh, it's 40 times earnings, I can't buy it. You can be like, I love this product and I can see all these other growth opportunities, and it's okay to buy things like that. You don't have to be like, oh, there's no way I can own this even though I love this product. Because sometimes you look back like 2 years later and the stock's up several $1,000%, and you're like, why didn't I own that? Right?
Yeah.
And then some people liked Pelotons, and it's like, oh, I should have owned it. Or Netflix, like, I really like the product. I should have owned it. Like things like that. Or Amazon, like how obvious was that?
Yeah.
I mean,
well,
was Amazon
I missed
like not
the
the
entire
most
time? So
I mean, it's easy in hindsight, but it's like, how obvious was Amazon? Like, come on. How obvious was Google? Like,
but it's interesting that in your own life, you're more attracted, it seems like, to the margin of safety. Like Valentine, for instance, right?
Yep. No, absolutely. No, and my point is like, but I do have Firefly inside of one of them.
Yes.
Right?
Yeah.
Right. And I do have Green First inside of one of them. And, right. So some of these have really interesting things inside of them. We have OpFi inside of FGF. OpFi is an amazing investment, right?
Yeah.
Green First is an amazing investment. Firefly could be a really amazing investment. So the other point on, so that's sort of like the T. Rowe Price mentality. T. Rowe Price was like one of the original like great growth investors like years ago. They sort of like, this is like, I don't know when Mr. Price was alive, but like he was like one of the first like amazing growth investors. So that sort of like resonated through the culture. And then Steve has his own strategy, which is different, right? He's like very focused on like the short term, but he also, he has .72 Ventures. He owns the Mets. Like he's obviously able to make bets that you can't sell in, today. And then I worked for a Tiger Cub. I worked for Lee Hobson, who ran Highside Capital. It was a $5 billion, at its peak, $5 billion Tiger Cub that's now, his family office. That spun out of Maverick. And Tiger's a really neat culture. Like they are sort of a combination of like buy growth companies that have earnings that are going to like materially beat the consensus, and they do amazing research. And like I just really, I learned a lot from Tiger. So
that's cool. That's a hell of a career, man. Now the transition of your operating companies is complete, and you can put your own cherry on top of yours. And maybe end up at your house a little bit more often.
Hopefully.
Living that Mike Mitchell life.
Hopefully.
In closing, I do have one question.
Okay.
You have a Super Bowl champion on the board of directors. How'd that happen?
So, a couple of ways, but mainly...
Mr. Sue.
Yeah, so my partner, Joe Muglia, who I've talked about a little bit already, who was the chairman of TD Ameritrade, chairman and CEO of TD Ameritrade. His story is an interesting one, but he grew up in the Bronx, became a... very interested in football, was a football coach first, and then went to Merrill Lynch and sort of rose to the top of Merrill Lynch. But after going to Ameritrade and was the CEO of Ameritrade, sort of had this real strong interest in going back into football coaching. So Ameritrade is based in Omaha, Nebraska, and Ndamukong Suh played for University of Nebraska as a undergrad. And Joe, when he moved from CEO to chairman of Ameritrade in 2008, decided to go back into coaching football. And his first football coaching job out of Ameritrade was at University of Nebraska when Sue was there. And he developed a great relationship with Sue. He introduced us a long time ago when Sue was much younger. And we've developed a great relationship. So I have the distinction of being, Ballantyne Strong is the distinction of being, if you Google Ballantyne Strong, Warren Buffett, Ndamukong Suh, you'll see that we are one of the only public companies in history that's had Warren Buffett quoted in their press release. So when Ndamukong Suh joined our board, we asked Warren Buffett to be quoted in it because we thought it might be controversial. Because Ndamukong's actually he's actually a really successful business person. And people are like, oh, you're putting him on because he's a football player. Like, no, we're putting him on because he's a smart business person. And the fact that he plays football, I could really care less about. I wanted a board full of great business people. And he is an extraordinary business person, much more accomplished than most. We knew that he has a great relationship with Warren Buffett. Warren's a big University of Nebraska football fan. So we asked, and he was also, at the time he was playing for the Miami Dolphins, and Stephen Ross, who owns the Miami Dolphins, we asked him to be quoted in the press release, sort of supporting it. And he said, I'll be quoted if Warren Buffett will be.
Oh, I like it.
Sort of saying like, you'll never get Warren Buffett to be quoted. So I'll never be quoted. So we're like, done. So we asked Warren to be quoted, and he's like, of course I'll be quoted. So his quote was, I would never want to run against Ndamukong Suh for a board seat. And I'm not sure if that's the exact quote, but you'll see if you Google it in the press release. And Stephen was like, he agreed to be quoted? And we're like, yes. So then he had to come up with the quote. And so both Stephen Ross, the owner of the Miami Dolphins, and Warren Buffett are quoted in Ballantyne Strong's press release. And Ndamukong's been on our board. He's a great board member. And since then, I've gone to a football game with Warren Buffett to watch Ndamukong Suh and with Todd Combs and with others, and sat in Sue's box with his family.
That's cool.
Yeah.
That's a fun story.
Yeah.
All right. Well, good, man. I'm going to let you get back to your job because I know that you were up super late, and I appreciate you stopping by. And anytime you want, the mic's open to you.
I appreciate it.